Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Weakening macros versus strong sentiment. Usually, when macro factors start to look iffy, when you're not sure whether the macros are actually going down and may go down further, that will reflect in the stock market and on investor sentiment. People will start becoming edgy. The more conservative ones will take a little money out of equities. A lot of people will try to play safe. Look at what Warren Buffett is doing now, and you can't have a better masterclass on how to create and increase your liquidity when the macros are weakening. But all of us think that we are clever, we can find opportunities in any market, and so we generally hesitate to take money out of even the most frothy parts of the stock market. I must have done so many videos cautioning people to take a little money out of small caps, especially the small cap funds. I tell people at least take your money out slowly, maybe do an SWP for 5 or 10 weeks, but take out some money. Keep that money so that you can buy when the markets fall. But nobody wants to miss out on any of the fun. Nobody wants to be caught out of the market with liquidity even for a day. So everybody is still all in the most risky strategies of the market, and nobody wants out. I saw one statistic which says that the STT collections, STT meaning Security Transaction Tax, are at a high and beating even the expectations of the government. Now, if tax collections in STT is beating the budgetary estimates of the government, what does it tell you? It tells you that people are speculating more. Nobody wants to go out of trading. Everybody wants to speculate and get the last rupee out of trading. Usually, when you take risks to the extent that you want to get the last rupee out of trading, what you do is you lose the last rupee of your capital. This has been the history. But today, retail investors are a new genre, a new generation, people who haven't experienced this, and they are merrily speculating. So it's like people playing on the beach when there is a tsunami warning. But that's what it is. So weakening micros and hardening sentiment is not unusual because everybody has a very high bias created by recency, created by the recent buoyancy in equity as an asset class, created by the hype in some parts of equity markets which have done extremely well, and everybody wants to be invested exactly in those parts. That explains the hardening sentiment. But the macros won't listen to sentiment. It's always sentiment that is either obedient to the macros or very disobedient. Now it's a turn to be disobedient, but someday the market sentiment will be forced into obedience. Between now and that time, investors still have a chance to redeem themselves, to redeem their money, and to redeem their risks from where they stand today. Essentially, redemption is not far away, but you can't take it too far. That's the message which I get when I see the macros and the hardening sentiment. Thank you for watching this video.